Hey everyone, hopefully having a good day. My name's Andy. My channel's Finding Value. We're going to rip through Twitter, see what people are sharing on social media. It's probably going to be related to three different topics: wealth building, financial topics, and or commodities. Those are the three that get me going at least, and the three that I focus on. I'll give you mine, interject my financial opinions, and we'll dive in here and see what people are talking about. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com, you can use the word discount to get a discount if you want to join. And let's dive in to see what people are talking about. So this guy, Caleb, he says, breakdown incoming for crude oil. I reiterate my sub $60 target. So he's got a sub $60 target on oil, and all he's got is a downtrend line and a line moving on up. It's not even a flag pattern. Maybe you could get away with a pennant formation that we entered from the bottom down. Maybe. Now, the way that I view crude is I don't zoom in as much as this guy. I zoom out. And what I did here is I took the fractal from 1998, which was the beginning of the commodity bull market, and I grabbed this. That's the fractal there. A fractal is a pattern that repeats over and over. And this is wave one and wave two. So if I were to zoom out, this is the fractal I just grabbed. It's right here. So what I think is occurring is that we've got wave one, wave two, wave three, wave four, wave five. And then we go into a consolidation period between these two levels here. That is so this was an expansion phase of real estate. This was a market recession crash and a recovery all the way to about 2020. We also see in those pullbacks a 1, 2, 3 hump consolidation, which then starts the beginning of wave one. So what I'm going to do is I'm going to move this over here, and I'm not going to put it to the bottom of the bottom. That was kind of a fluke, I think. And then I'm going to increase it. And this is potentially what he is probably talking about. And I'm just trying to mimic what he's got. So what I'm going to do is I'm going to blow this out a little bit, hit one for 1 year, back it out. So I think that what is occurring, kind of stretch this thing probably too much, is this move here. You can see these three distinct humps and the three distinct humps on there. This is probably aligns with the top here. You get 1, 2 humps, then you get a move on up perhaps, and then you get a move lower. But here's the problem. This was an accentuated move here, because look at the bottoming pattern that we got on the bottom here. That is this little guy there. So if I were to shrink this up, and then put it over. So this is what I think is occurring. I'm going to have to go down and go up, I guess. I think that is your fractal of the right-hand side. These things kind of stretch up and over, but this is the fractal that I think is occurring on the right-hand side here. And you can see that this could potentially be a bottom. Now, another thing that I do is I don't just look at like previous patterns and fractals. And even if this does break down, it's going to be a better buying opportunity, in my opinion. But what I see here is I zoom in, and I would say it's a pretty balanced market. What I look for is the green army showing up, and you can see there's a downtrend line here and an uptrend line that I just drew in there pretty crappily. So let's just get it kind of moved up. So we are squeezing up into the corner. And the green and red candlesticks are pretty evenly matched. So what I do next is I say, okay, let's go look at the crude oil to gold ratio, because maybe we can glean some information from that. And what I see here for crude oil, or the ratio of gold versus crude oil, is I see a little bit different picture. What I see is a uptrend that has broken down, has gone up to do a retest, and it's working its way now lower. So if I were to put this in here, this is what I see. And this is just a reversal it's a flipped image of what crude oil is doing. So we've already broken down in terms of crude oil breaking out against gold. And you know what generally causes that? This does. The 10-year yield. And the 10-year yield's already broken to the upside. You can see we've got a nice little flag pattern angled downward. And all you guys know this, if you've been on the website, I've done many training sessions on all this. So there's the flag pattern. It's generally a continuation pattern to the upside. When yields go up, gold goes down, crude oil goes up. But generally, crude oil leads yields most of the time. So I think that crude oil probably has a pretty good shot of breaking to the upside based off of all of the information that I just went over right there. So this guy's looking at one chart, and some people are saying that this is a shoulder, head, and a shoulder that's developing. I don't think that's the right move either. You need to tie this all together. We've got a shoulder, head, shoulder. I think this is going to break to the upside. And if I'm wrong in the short term, it doesn't matter because I've got valuations on my side where the gold to crude oil ratio is at 27. That's cheap. And I like it in this general area up here when it peaked out at almost 30-to-1 ratio. Historically, a 30-to-1 ratio is uber cheap. So it's about stacking a bunch of information that you can get from history. There's the 30 ratio. These are all buy signals at the 30 ratio. And they all went lower after that ratio if you held long enough. So what I do is I get the ratio, I get the wind at my back. The 30-to-1 ratio is right here. Get the wind at my back, purchase some of the technically sound, good, solid companies, and wait for this to come back down. And then the bottom end is generally around 6 or 7 is the bottom end, outside of that negative oil price. But 6 or 7 is what it got down to in 2008. I think we are heading way down there. Now, another thing that you can do is you can flip this around, use crude oil divided by gold, and you'll get a different picture here. This was a crude oil outperformance of gold. And then from this point forward, it was a consolidation. And then this point forward, we're going into another bull market in gold. Another way that you can, or I mean in crude oil, sorry, crude oil is going to outperform gold. So what another thing that you can do and look at is, to me, this is angled downward, which is generally good. And it's basically a flag pattern that you've got in the ratio. So I think that we could easily potentially move on higher with a long runway of ratio to go up against gold. Now, what would cause this, and what market conditions does crude oil outperform gold in? Well, in an expansion phase of real estate, and again, I'm not stating anything here about short-term market movements. We easily could go down like that before going higher. But big picture view, in an expansion phase of real estate, at the end of those expansion phases, crude oil generally outperforms gold. And look what we've got. The last bull market started in 98 and it ended in 2008 here. So this was the last bull market that we had. And I can take that fractal, I can overlay it, I can do whatever we want. There's the fractal going into the bottom of 2003. And then let me guess, I bet you this looks pretty dang similar. So here is the fractal of it moving. And that's the last fractal that I just grabbed back here. So to me, when we got to this level here, which is what I grabbed, you can see that we are basically ready to go on up at any point here. And that's the same fractal is what I've witnessed in history here before we get another surge to the upside. And this could be a very big surge. So there's more information there. Another thing that we could look at is we can look at rig count, which is way down and bottoming, in my opinion. Rig count, we've got drilled uncompleted wells, which are basically at have depleted in terms of inventory. So I would say absolutely everything that I watch and listen is bullish oil. And I think if we do get a move to the downside, it's only going to be temporary. And you could listen to quarter three calls, hopefully soon quarter four calls of the drilling companies to see more information about the insiders talking about drilling activity. Because if drill rigs are starting to go up, generally price leads the activity. I think there's going to be a lot of activity occurring in quarter two, quarter three of 2024, at least the land-based ones. But everything that I see looks good from a ratio perspective. So I would, respectively disagree. But if he is right, I think it's only going to be temporary in the short term. Amazing what the EIA can do now that is copying hedonic adjustments of inflation from the Fed. When steak gets too expensive, substitute ground chuck. The EIA now substituting natural gas liquids and miscellaneous oil for crude oil and condensate. So they're adding in other stuff into this number here that makes it look like it's going up. I've been doing a little bit of research. I was listening to Art Berman talk about potentially peak oil occurring sometime around 2024, 2025, or maybe even right now, and how well performance has been deteriorating over time. It's been declining. So well performance is basically how many barrels of oil you're getting uh, per well, and that is starting to decline. So they're making it up by volume to try to stay flat. And then I think eventually we're going to get a turnover in tight oil, and that could mark a peak in worldwide oil production. Could be. But I've got more data below this. I'm just trying to piece together all this stuff. Now, here's another piece of information that I think is really important. This is the Saudi rig count growing, bullish jackups. There's also other providers that I know that are providing rigs to the Middle East, which I'm invested in. But check this out. This is the number of rigs drilling for oil in Saudi Arabia. Here's 2021, 2022, 2023. That's going up. Now, here's my question for all of you. I thought Saudi Arabia was pulling back on oil production. Then why are we seeing the number of rigs drilling for oil in Saudi Arabia? Why is it skyrocketing? Kind of interesting. Now, I don't know the answer, but that's my question. Why are we seeing the number of drilling rigs go up at the same time that they're supposedly cutting production? Are they doing drilled uncompleted wells all over the place? Like, what's going on here? I also know from the quarter three conference calls that I've been listening that the Middle East has a buttload of tenders out there for more drilling rigs, a whole bunch. Are we seeing peak oil right in front of us where their productions are potentially peaking and that they are going to massively increase spending on drilling? I don't know. Kind of interesting to piece this all together. Switching gears to uranium, it says uranium's strong fundamentals has nothing to do with the economic cycle. Repeat, has nothing to do with the economic cycle, says David Rosenberg, the guy who's been calling for a crash the past couple of years. Now, what I'm going to say here is every single time we've had the economic cycle go into an expansionary phase of real estate, that is when uranium has gone up. We are in the middle of an expansion phase of real estate right now. And we're getting a little bit of a slowdown. That is correct. But oil is going up. That's this cycle here is what I'm talking about. It's this cycle right here from bottom to top. That is the expansion phase of real estate and the economic cycle, and that's where we get credit expansion and stuff like that. That's also where it has an impact is the S&P 500. So if I were to pull the S&P 500 in a new pane, generally speaking, you'll get a sideways move from this onward. You'll go into a consolidation where you get a consolidation at the same time that commodities go up. So there's your consolidation. That's when commodities go up. Interest rates generally go up during that time frame, and uranium has gone up during this cycle every single time. And we're in the middle, in my opinion, of this cycle right now. So if I were to grab bottom to top of this, I'll just lose this. And I were to put this over here, and this is going to be on non-logarithmic though. Oops, I meant to grab the top of this. And I were to uh, put this large and put the fractal roughly the same. That's what it looks like. It states here that oil could potentially, if we were to have a repeat of 2008, go to like $600 a barrel. And what that means is that we would have a very tight market, probably supply driven. It could be peak oil. It could be the credit coming into the system at a faster pace than what oil can keep up with. This will have massive ramifications to interest rates in the market. And I think this is what's probably coming. And I don't think people are thinking about all this, but I think, obviously we've got the right market conditions for this to occur under. And there's the fractal that I just overlaid, the start of it to the peak of it, and then that's roughly what it would look like. But uranium has moved only under those market conditions. I think it's very dangerous to say that it has nothing to do with the economic cycle. Now, I'm sure that there's the supply demand imbalance, but I do also think that some of this is stacked on top of it. And that's one of the reasons why uranium is going up. It's one of the reasons, not the only reason. ASX uranium stocks at the open, we can see a lot of red, a lot of large selling pressure down days. And obviously there's some that are going up, but majority are going down and with some size. A lot of people see all these posts and it's like, guys, this is more like running a mile to a 5 mile race, maybe. Or maybe you call it a marathon for most people. So we're running a marathon, but every single day people are watching the daily movements go up and down. I think that's dangerous to do that and be so connected to it where each day it has to go up. I'm not saying from Patrick. I'm just saying in general, a lot of people think that this is just going to go up, straight to the moon. That might be the case, but there's a lot of pullbacks that occurred in previous bull markets. It's a marathon, guys. You got to pace yourself. Don't get too crazy tracking, following, and doing this stuff on short-term time frames. It's a marathon. Be prepared for a marathon. Don't be prepared. We're going to have pullbacks of 25, 30, 40, 50% in a lot of these names. Get ready for it. Oil's been consistently rallying in Asian time zone and falling by similar amounts during the US hours. MS just updated their numbers for the last month and it's plus 10% and minus 10% respectively. This is a significant statistical bias. Yeah, I talked about this as well. I think someone even posted that I noticed that. But I've noticed that as well. And it seems like it's just getting sold off when we open in the US markets. Kind of interesting. Is there manipulation? I don't know. Who knows? But it won't last forever. If there is manipulation, we'll see shortages in the market and it'll solve itself, I think. Is uranium entering its insanity phase? With you hitting triple digits, we would, of course, be remiss if we didn't mention it yet again. Let's talk about what's happening with producers and fuel buyers. Have we reached the stage where utilities finally step into the market? Look, there are a number of public RFPs out there where not a single producer has even responded. There's hardly any pounds in the next few years from Camco and Kazatomprom that aren't spoken for. If you need pounds, you need to do a venture capital and back a junior and hope the damn thing produces. The spot market has been cleansed of pounds, and now the producers are missing their targets too. This is the world's biggest uranium miner warns of production shortfall, and that's Kazatomprom blaming it on sulfuric acid shortages. So uranium prices have obviously soared on the demand boom. Imagine how scary that must be for a utility when your inventory is drawing down and no one will even pick up the phone. There's an old saying, if you're going to panic, make sure you panic first, because if you ain't first, you're last. So we think that someday soon, a utility will sweep the book for a few £1,000,000, then every other utility is going to be forced to follow. Want insights? And then he talks about that. But that's exactly what is occurring. We are basically dry of uranium pounds. When these guys are going to all go and look for it, I think at some point they're going to panic. And I don't think the panic has set in. I think this is like the pre-move before the panic move. And what I'll say is get locked and loaded. This is not, it probably won't go straight up. The futures pricing might, but some of the equities might not go straight up. Think of this as more of running and pacing yourself on day-to-day market movements than trying to sprint and just go straight up. It's possible it goes straight up. The equities I'm referring to, it's been a pretty easy ride in past bull markets, but a lot of the times people get impatient and they sell out too early. Energy Cynic, it says WTI is still struggling. Key points. U.S. production is flatlined. My view is shale is peaking right now at these prices. Most analysts expect up to 1 million barrels per day of U.S. production growth. It will not happen. And if it stays flat, the risk of OPEC and winding cuts is low. I remain bullish. But here's the thing. OPEC and the majority of the cuts came from Saudi Arabia, right? Why are they increasing their rig count? What is going on over there? What is going on over there? Coming on down, so there's oil production. You can see the month over month increase, and the change has been mainly lower, not higher. Permian's been making up the difference. We're down two in terms of change, in terms of these differences of these 1,000 barrels per day. And I do think that maybe the cold weather might have an impact, but this is January 2024 versus February. So we'll see. We'll see what occurs. This is the Arctic cold has created many derangements from the typical nat gas supply-demand balance. Production down minus 2.1 billion cubic feet per day versus 2023. Imports are up. Power burn at summer levels are at 38, which is up plus 9 billion cubic feet per day. And residential commercial heating demand at 71.3 billion cubic feet per day near record highs, up 27 per day. So we've got a lot of demand increasing. Now, here's a couple of things I want everyone to focus on. LNG exports are up. Exports to Mexico are up. Power burn, way up. And I think that will continue to go up. Industrial demand, up. Residential consumer, now we had cold weather there. I'm going to discount that. But just notice how we're continuing to increase the demand for natural gas on a year-over-year difference in a lot of these areas that are not weather dependent. News, Zillow issues an upward revision for its home price forecast. Zillow expects U.S. home prices to rise 3.5% between December 2023 and December 2024. So that's in line with an expansionary phase of real estate, with the market being tight. Prices go up when inventories are tight. Now here's Scott. Scott says, in a commodities bull market, where we are aiming for a 10x plus, things can feel euphoric for quite a long time. The runs can be relentless. I remember being mind-blown and thinking, is this even real during the 2009 to 2011 silver stock run? Always do your own research. And I agree. We're going to get these moves that are going to be ridiculous, and they're going to run. So get ready for it. It may not go straight up. We might get some wicked pullbacks as we go in some of the companies. But we can also see some ridiculous runs here in uranium, in silver, in oil coming up, I think, very soon. Gary says, and this is more about the metals, time to be patient. Metals are going to give us the last best buying opportunity before the bubble phase begins. But they have to finish this intermediate correction first. I will be monitoring this in the SMT premium reports and will try to make a real-time call when I think the bottom is in. And it's time to buy and buy big, is what his opinion is. And I think we're getting close. But again, I think that's going to be yields dependent. So you got to watch yields. Yields are the driver of a lot of these things, and we might be increasing in yields for a little bit. So, patience might be required. This is within the last hour. Projected real-time nat gas inventories have fallen below 2021 levels. So this is the most bearish projected real-time against the 5-year average. The 5-year average is about 2783. Right now we're at 3003. We've got a big draw coming. And we could easily get to that 5-year average if the draw is real big. So we could come back to the 5-year average or below by the end of the winter. It's still possible. The EAI says production will average 105 billion cubic feet per day. This is natural gas in 2024. They expect surplus to tighten by 180 billion cubic feet in 2024. That means you're running a deficit. That means they expect demand, domestic versus net export, to average 105.5 billion cubic feet per day in 2024. So production is less than 103 and demand is greater than 107 billion cubic feet per day. Completion still falling, demand is growing. And that is what I want people to focus on. You're in these investments because there's deficits that are being created all across the board in all these different commodities when you start to follow them. I think nat gas will hit $10 plus the next time we have a deficit of 200 billion cubic feet per day versus the 5-year average. Not sure when that will be. Some will say never, but fundamentals should tighten and we'll get there eventually. And I agree with that. He says the smaller storage capacity gets relative to demand, the more sensitive price becomes to variance from the 5-year average. That's the unique part of my thesis, his thesis, in a nutshell. But there's a few more major key elements. Producers swing between producing too much and too little because of long production lead times, inability to respond to price efficiently. We are almost out of drilled uncompleted wells, which adds at least 5 months to the already long lead times. And that will be a major issue when the next need to grow. So they're low on the drilled uncompleted wells. You know what that means? We need to do a lot more drilling. And guess who's bullish on drilling? The guy who's talking to you. Now here's another thing. This is data that backs it. I'm a data guy. So Paul keeps the basic scatter plot of price related to variance from the 5-year average. It's a visual representation of this person's thesis, which is that the fit line negative slope is increasing. Bigger price changes at smaller volume changes as days in storage shrink. So what occurs is your inventory levels are staying roughly the same, but we are dramatically increasing the demand and supply production of natural gas. So the percent of storage in inventory is becoming less and less of production. So you're going to see larger and larger swings in the natural gas price whenever we do draw down on natural gas inventories because it's a smaller percentage of production. And his thesis with data supports that. You can see 2021, you can see the scatter plot in the pinkish color start to move up. And then you can see 2022, it moves up even further. And right now we've had weather on the good side of natural gas to stay low. But if the weather shifts and gets to the bad side, where nat gas prices could dramatically go up because we don't have the storage and inventory to buffer us against it. Hence, as demand grows and inventory becomes a smaller percentage of demand, you're going to get greater and greater volatility in the price changes as we eat through inventory because inventory cannot buffer the amount of demand that's in the system now. And we're seeing it with data. And I think we could easily get to 10, 12, 14, 15, $20 a million cubic foot in a heartbeat if the right market, if the right weather conditions come. It could really move us to a high level. Crude oil production from the Bakken, Eagle Ford, and Permian has been down to flat over the last 3 months. Those three regions represent 64% of the total U.S. crude production. And that is what we are looking at here. Is you can see that we are year over year crude oil production. Oops. Year over year crude oil production, it's starting to go flat here. You can see the flatness. We are not injecting into or I should say, we are not growing production on a month to month basis. Here's your year to year crude oil production changes. And you can see that we are growing in a lot of these areas. But we've shrank from February onward, we've been declining. And that is something that is worth noting. We could be in peak oil. But again, if oil prices go up, we could easily see a surge in production. So it might be peak for the price that we have today. Recent history has shown that the 10 versus 2-year yields unwinding as favorable for gold, silver, and miners will definitely be a rocky road with full of turbulence. So generally when the yield curve uninverts, when this goes upward, that is when gold moves up. So gold bottoms at the bottom here, and then it goes up during these uninversions of the yield curve. That's the 10 versus the 2. Now, we've got a weird situation where the yield curve is uninverting with yields going up. Those previous times in history, the yields were all going down as it went up. So that is something that is very different than previous markets, in that we might need to wait and see and get yields to go down for gold to go up. And right now it's not doing that. We've got a bear steepener going on. And that's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. We've got a platinum question answer session coming up on 7 a.m. Saturday, Mountain Time. So see you there if you're a member. Bring your questions. And we'll catch you next time. This is Finding Value.